Welcome to TheoTrade. This is Don Kaufman. You are watching our weekend edition here on January 23rd, 2016. Let's get you up to speed at what's going on in the markets and what we've seen not only this last week, but what we can expect now next week. The question on all traders' minds, is this a real rally? What exactly happened on Friday? Well, this is what we look for in the midst of a down move, which is precisely what we've seen really for the first 3 weeks of trade this year, right? We've barely had an up day in the last 3 weeks. Here we are, Friday, explode to the upside. And I'm not sure if explode necessarily is the right word, but this is that kind of quintessential, if you will, bear market explosion to the upside. But a lot of traders are now sitting there with this idea like, all right, well, maybe this could be something bigger. Maybe the sell side activity is over. And that's what we're going to explore over here. So the question really comes down to, was it a buy the dip? Or is this going to be a fade the rally? And I think you're going to be surprised at a couple of things that we're going to look at. First and foremost, coming into this next week. So I don't want to dwell on the past. We've had a lot of down days, okay? A lot of volatility. But the S&Ps have been rather resilient. They're back into the 1900 range, okay? The first thing is, again, don't want to dwell on the past, want to look into next week. In next week, with 6 days to go to the expiration, you'll see the volatility has actually dumped off back down to 22 and about 0.5%. We're looking at about a 47-point expected move throughout the course of the week. However, you have to be very mindful. There is some big news coming out this week. So we're looking at a 47-point move, which pretty much takes us, right in the neighborhood of that 1950 level, but right back down to like 1850. But you also have to think expected move, okay? There's also, again, expected move is a probability of expiring, but there's also probability of touching, which is roughly double the expected move. Now, if you're curious about that, I'm actually going to be doing a class this Wednesday. Everybody that's signed up for TheoTrade in any way, shape, or form, it's free right now, but come to the class. It's going to be this Wednesday, 8 p.m. Eastern Time. Come to the class. It'll be in the regular Theo chat room. So you just log into TheoTrade, right in the Theo chat room over there. We're going to be hosting the class Wednesday, 8 p.m. It's all about volatility, expected move, and it's really about coping, okay, in a marketplace like we're in and like we expect for the vast amount of 2016. Nevertheless, one thing does surprise me here about the expected move. So the volatility gets crushed back. But again, let's not forget, if you look at the calendar, there's an FOMC meeting. There is. Okay, there's a lot of numbers coming out this week. So people like GDP. Come on, there's like a million different types of GDP that come out. But yeah, there are. Okay. There are quite a number of numbers coming out throughout the course of this week. The big one, though, people are going to be thinking about is the FOMC. But again, you can't forget about like GDP over there because they can revise other GDP numbers. So what surprises me, though, is that volatility gets crushed back, that it's not higher. Now, that could change in a moment's notice on Monday morning. But again, I want you to be thinking right around a $50 move in either direction is kind of what we're expecting in the SPX for this week. But that's neither here nor there. That's not going to help you to be able to differentiate direction in the market. All that is statistical, okay? And it's basically relying on the option price to say we're going to move up or down X amount. That's what the market says, okay? Now, let's get into it. Was this that quintessential, again, bear market rally? I believe so. And I'm going to show you exactly why. What you're looking at here isn't just a chart of the SPX. This is a 3-year weekly. Okay, this is a 3-year weekly, and it's a comparison chart. So I'm actually going to supersize the screen over here. It's a comparison chart. Why do I look at a comparison chart to assess, okay, a short duration bounce over here? Well, because there's been this monstrous divergence, okay? And these are 3 major indices, which I'll elaborate upon in a moment. And I've been talking about this divergence, okay, from one index product to another for quite some time. And it's my belief that the volatility does not subside until we converge. And that ultimately means until this index product up here comes down, meets Mr. Index product down here, and comes back into alignment with the index product down here. What are these products? Okay, number one, on the top side over here, we have the NDX, which is none other than the NASDAQ. So we're looking at the NASDAQ over here. Over 3 years is still up. Okay, 54%. Number two, right in the middle over here, is none other than our primary product on this, which is the SPX, up about 26%. And number three, coming in last, none other than the Russell, which, man, did that thing get pummeled the last couple of weeks. It's been quite spectacular. But you can see this immense divergence. But what I do want to point out is, we start to zoom in here, you'll see that the NASDAQ did crumble. Okay, quite a bit more than the S&P, but we still expect that these products at some point converge. Okay, so no matter how far back in time you want to go, let's go to a 5-year. Okay, you can see these monstrous divergences do exist from time to time. So here's one. Okay, when is this? Since 2012 timeframe, these huge divergences, and all of a sudden we converge. Now, when one index product converges upon another, I want you to think about this. When one index product converges, again, they've diverged out here, and I really want to get into the finite details. This is the divergence, okay, from the other products over here. What drives the products back together again? There's only one answer: extreme volatility. And in extreme volatility, the products converge. Okay, so we see it again. Very, very substantial divergence. Once again, volatility, okay, down moves. And what you ultimately see is you see the product that is the best performer ultimately converges upon the other products, meaning it actually falls faster. Now, we saw some of that, okay, in recent trade. It does not mean that we're going to be right back into volatility necessarily this next week, okay? To me, it does mean, though, 2016 is going to just be a wild and woolly kind of a year. We are going to have some wild moves. And no matter when you look back over time, you're going to see when products diverge like this, major index products diverge, okay, you will have a period of convergence. That period of convergence is met with extreme volatility. So I'm now even going to go back all the way 10 years, because I want to show you where these have existed. And when you look on 10 years and you look at the NASDAQ versus the Russell versus the S&P, I mean, the only thing I can say about this is ruh-roh. I mean, this is ominous, okay? Because you start to realize, all right, over the last 10 years, I mean, this is going through '08 and so forth, and there was huge divergences even coming into, 2008. But this is one of the largest divergences. Now, everybody goes, well, this time is different. Listen, I'm not a market technician. Okay, I'm much more of a quantitative trader. And no matter what you go back, statistically speaking, throughout history, okay, you will see these divergences and you will see them converge upon one another. And everybody looks back, they'll go, well, it tried to converge back here, but it didn't happen. Okay, it's trying to converge back here, but it didn't happen. So we've actually started some volatility at this point. Okay, and we're wondering, well, is this thing going to come right back down? So this is a much longer duration look. This is a longer duration look, obviously 10 years, and 10 years is not going to tell you anything about what's going to happen, for instance, next week. Go back to a 3-year weekly again and see this, pretty monstrous divergence going on. But now let's get into more finite details. Let's look what's possible here for the next week. And to do that, so again, our expectations are still of extreme volatility for 2016. Okay, unprecedented volatility in 2016. That was a much longer term look. Now let's get into the short term. Because in the short term, we have to get a better feel of what we're expecting this next week. Granted, there's some news coming out. The FOMC, I have to tell you, I don't expect much out of the FOMC. What are they going to do? Okay, the world is cutting their expectations for growth. So I'd be very unlikely to see the FOMC do much of anything other than we'll wait and we'll think about it. I mean, that's Janet Yellen, by the way. That's my Janet Yellen imitation. That's the best I can do. The lines drawn on here is for the S&P, the E-minis. Okay, the first bout really of any resistance I think we'll see, and I'm going to put this into numerical terms, is probably right around the 1911. So here we have the S&P futures trading pretty much 1900 on the button, 11 points higher, and they're going to meet a degree of resistance. From there, we could possibly pop into the 1925 range. It wouldn't surprise me to see markets rally a little bit more and then possibly get smacked back down. To the downside, 1871. 1871 is the number to look for on the downside. Could be a degree of support. Again, we've actually seen this level time and time again, but 1871. So these are the levels to look for early in trade. But let's dig a little bit deeper than just that. Okay, when I say dig a little deeper than that, like, again, is this a bear market rally? One area that is extremely precarious, okay, you saw volatility drop. Now, forget about the VIX. The VIX, dead to me, because the VIX is, I mean, it's just, again, I kind of feel like it's my predecessor's, like, volatility product. It's not in the know. What I do look at, though, for volatility is the volatility futures. And that's because it's a traded product. I mean, these things, they're rocking throughout the course of the day. People are trading them. So you see the 25-day vol futures, okay? The 25-day vol futures. And those volatility futures, okay, are roughly at, 22.72. Then you look down and you see the 53-day vol futures. They're at 22.17. So we're still in, okay, an inverted volatility state. It's actually known as backwardation, meaning that short duration volatility is still above and beyond the longer duration volatility. What does it mean? Okay, even though it's negligible, it's about a 50 cent, again, just about a 50 cent, okay, backwardation over there. Negligible, but it kind of means risk is higher in the 25 days than it is the 53 days. You go a little further out in time, 88 days, okay, and it's still at 22.07. So again, if you were to sketch this out, all right, you would see volatility here and kind of dropping off just mildly, okay, as we go through time. I'm making my own chart, so it just drops off mildly. Again, short duration volatility still above the back duration volatility means one thing to me. Risk is still imminent. Here's the ominous area. The ominous area to me, okay, of this rally, and the thing that leaves us in really precarious, I don't care that Apple rallied 5%. Oh my! And they're coming into earnings. Oh me, oh my. Apple has been slaughtered, okay, well before the sell side activity even started. So it's not surprising to see this. I mean, Apple's off the 120, and I want to make this clear now. I no longer have a short position in Apple. I covered all my short positions in Apple throughout the course of this last week. So, ladies and gentlemen, boys and girls, I ain't an Apple no more. I'm done with it. Okay, I covered it, and it was been a fun ride from $130+ down into the mid-90s, but I have covered my Apple position. So what's the precarious area? Okay, it starts with me, okay, with the XLF. The XLF, which happens to be none other than the financials. Did they perform well? Yes, but they underperformed the S&Ps yesterday. They have also been beaten down, okay, in the sell side activity. But it was the XLF that drew my attention, like, okay, it didn't perform as well. So it's only about 0.2%. What bothered me about the rally, the bonds are not buying it. Okay, the bonds, when I say they're not buying it, I don't mean they're not buying them up. I mean, the bonds, they barely sold off. Why didn't capital rotate out of the bonds back into the market? It's because this wasn't real buying in the market. This was short covering. Short covering probably took us up, okay? And we got a couple of people trying to bottom fish markets. But it is my conjecture that, no, this is that kind of quintessential bear market rally over here. Now listen, it can have legs. You could see markets come up a little bit more, maybe Monday, maybe Tuesday. But I am telling you at this point, be on guard. All right? Be on guard. Directional bias is extremely difficult in a situation like this. That means, what do you look to do the next week? You look to be a premium seller. You look to be a premium seller because, again, you need to see these bonds dump down. Look at the action in the bonds, okay, since the beginning of the year. Forget about anything previous to that. Just look since the beginning of the year. They're from the 153 level to cracking all the way to 160. That doesn't just, I mean, that means like, Armageddon! You need to see these bonds come off and come off big. They get back down to the 156 level. Okay, call me crazy, but then, and only then, maybe we really rallying. But the bonds barely backed off, which tells me, okay, this is not a good thing for the broader markets over there. So outside of, volatility, outside of anything else, watch the bond markets. Okay. Now the bond markets are also going to react to the FOMC meeting. They could have a little bit of a muted response, but the bond markets right now are still displaying, okay, that we are in a highly risky situation. The volatility futures are still displaying what? Risk is imminent. Until otherwise, risk is here, risk is now. With that, once again, we're going to be doing a class here at TheoTrade this coming Wednesday. Again, this coming Wednesday. There's no football games. There's no football games on Wednesday. Football is almost over. It is going to be Wednesday the 27th at 8 p.m. Eastern Standard Time. It's really, again, all about volatility, expected move, and how to be effective in more volatile markets. Join us.